The last round, having explored liquidity traps and their pros and cons, income distribution, a historical tour de force from Bill Miller, and a wonderful conversation with central bankers present and former, also good friends, as you can see. The question now is, what do we do with our money? And to moderate this panel is Bill Clark, who's a dear friend of many, many years, I'd say. And in his other capacity, besides being an active member, speaker, participate in the Global Interdependence Center over the years, he's the chief investment officer of the Federal Reserve's own pension investment fund. So in that capacity, he'll introduce his co-panelists and moderate the next panel. Bill.
In advance, pardon my voice. I'm just suffering from a cold, but I think we'll be fine. So this is actually my fourth GIC event in Europe, each one being bigger and better than the last. This one's certainly been fantastic. This group has the difficult challenge of following some tremendous panels both this morning and this afternoon. But I do think it's appropriate to wrap up with this panel because, as David said, I think the objective of this group is to apply some of the perspectives that you've heard throughout the day and actually use it to make or talk about real-life investment decisions in dealing with client portfolios. And I think everyone up here either is involved personally or directly with managing client money or advising folks directly who are. So the panelists are Josh Rosner, who's a managing director of Graham Fisher, to my immediate left, Peter Demirali, managing director at Cumberland Advisors, Michael Drury, chief economist at McVeigh Trading and Investment, and then finally on the far end, Steve Sexauer, CIO of Allianz Global Investment Solutions. So the format will be each of our panelists will give 10, 15-minute presentation. I'll have a couple of introductory questions, but we're going to try to save as much time as possible for questions from the audience. And with that, Josh, I believe you're going to be talking about the prospects for U.S. federal agency debt.
Right. So the subject and question is Treasury debt. Do you buy it? And I guess the answer can be given in one word, so I can make it less than 15 minutes, and the answer is yes. But I'll go a little bit further than that. The GSEs are again being sought to be used as tools of social policy, even though there remains no coordinated effort to consider the need for national housing policy. Nobody's in charge. The Fed owns a significant amount of agency MBS and have little input into GSE policy, even though their monetary policy is affected by frictions resulting from failures to address GSE policy issues. The GSE's own regulator, the Federal Housing Finance Agency's role, is not to consider housing policy or macro social or macroeconomic need, but to conserve the assets of the enterprises. Treasury owns 80% of these companies, though their preferred stock purchase plans, through their preferred stock purchase plans, yet they have little control over the GSE's governance. And Congress refuses to take the necessary steps to define the future shape of the GSEs, their policies, or housing policy broadly. How did we get here? And largely, we can answer that with, as a result of social policy engineering, we increased home ownership rates from their historic equilibrium rate of 62 to 64% towards, beginning in 1995, 70% by 2004. This was driven by structural changes, the move from independent bank underwriting at the branch to automated underwriting, the perversion of the independence of the appraisal process to the move towards automated valuation models, changes in down payment requirements, which had persisted at 20% for almost all mortgage products since the beginning of the 1940s. And then in 1995 and 1996, the application of loss mitigation instead of foreclosure, even though in the fastest appreciating markets of 2001 to 2007, loan modification redefault rates at 24 months were between 20 and 25%. nobody really considers, as there are increasing calls for principal write-downs of agency and private debt, the fact that there's no empirical data supporting the effectiveness of this approach. The GSEs were created to provide liquidity to the secondary mortgage market, and they failed. They provided so much excess and uneconomic liquidity in good times that ultimately their own safety and soundness ended up in jeopardy. Ironically, the bubble years of late 2004 to 2007 were not driven by fundamental increases in demand for home ownership. In fact, ownership levels barely moved during that period. During that 2004 to 2007 period, it was malinvestment in second homes and investment properties, as well as cash-out refinancing, that their excess liquidity supported. As a result, when the crisis hit and the GSEs were called on to provide that support for the secondary mortgage market, they had no capital with which to do so. Today we're playing a dangerous game of recreating the GSE's role as the political honeypot that they were prior to the crisis. We've recently seen Congress increase the guarantee fees that the GSEs charge, not to increase their capital, but to fund a payroll tax cut, which ultimately means they're being used again as a political tool rather than a tool of sound housing policy. We are now risking, on the other side, the conservator, whose job is to conserve the assets of the companies, beginning a process of selling off the GSE's most valuable assets to benefit their estates. Ultimately, this may include the multifamily housing businesses. Either way, we are, without a real public or political discourse, increasing the government's obligations to creditors. Thus, my answer that agency debt is, in fact, at this point, sovereign debt, and given the increased spread over treasuries, there's very little reason for major concern in purchasing that at this point. From 1999 to 2007, there was a push for new legislation governing the GSEs, but few in Congress were willing to consider systemic risk as part of the GSE's futures. As a result, receivership language and conservatorship language were left out of any GSE legislation until after the crisis was at our doorstep. When failures became obvious, finally a law was passed which created conservatorship and receivership language, which limits the regulator's hand by requiring to conserve those assets of the companies. And pressure is mounting today to do principal write-downs, even though there's no actual evidence that exists to support this as NPV positive, and nobody's figured out how to address the moral hazard risk of providing write-downs for delinquent borrowers without inducing even more delinquencies. How is this all relevant to the question of buying agency debt? Congress has failed to define what the GSEs are today or will be in the future. Yes, they're 80% owned by the government, but they are still private companies with private preferred debt and private preferred shareholders that must be considered in government actions. Until we decide to fully absorb them as direct and public government obligations, there are legal issues preventing them from being fully used as tools of necessary social policy. The GSEs today are almost profitable again. In certain quarters in the past year, they have been profitable, minus the dividend that they're required to pay to the U.S. Treasury as part of their preferred stock purchase agreement. And they could be building a capital base with which to rebuild their viability as potentially private companies. We've used forbearance to rebuild failed banks' capital, but we've chosen neither forbearance nor, on the other side, nationalization for these two largest financial institutions. So, the question of whether or not to buy agency debt will in part be defined by the legislative and policy decisions to define what they are in the future. Reprivatized institutions with a new role as catastrophic loss reinsurers, two government agencies, one government agency into which the other is folded in. The interim is unclear, but the reality is the U.S. government is not likely to abandon the obligations to senior debt holders, especially given the political risks of harming foreign central bank holders. As a result, buying Treasury-backed GSE securities with the enhanced yield is logical. While we could see a move towards issuance of a single security by the two companies, I would still expect the debt to be supported for the foreseeable future. Still, there is a risk that as Freddie's spreads widen, they'll see more of their customers sell their mortgage volumes to Fannie Mae, and there's little Freddie could do to pull those spreads in, given the fact that Congress has limited their portfolios with which to buy their own MBS. If the two are collapsed into one, and we were to see a good bank, bad bank solution of one, we can re-engage in a new discussion of whether it will make sense to buy agency debt at that point. As for the issues of principal write-down, it appears that Paul McCulley's call for greater coordination between fiscal and monetary authorities may come to pass through the GSEs over the issue of principal write-downs in the near term. It's possible that we'll see the U.S. Treasury provide financial incentives for the GSEs to do some principal write-downs without forcing those losses directly on the GSE creditors, and rather place them on Treasury. Still, this would be done with further distortions to capital markets, as bank-owned second liens would be protected ahead of what should be the first liens that are senior in the capital structure. While reprivatization of the GSEs as companies with real countercyclical insurance roles would become a viable outcome and may become the best way to recoup taxpayer expenses, the abject neglect, and worse, the use of them as a honeypot, risks further costs not only to the taxpayer, but to the GSE's social policy roles. More broadly, with demographic changes causing me to consider further declines in home prices as tailwinds become headwinds due to demographics, we really need to consider better definitions of housing's role and the role of the private mortgage market in our financial system. There are real and viable policies for productive and plausible solutions to our current housing malaise and current consumer risk realities, but unfortunately, Congress has yet to take up those discussions in any meaningful way. Thank you.
Thanks, Josh. Peter Demirali.
Thank you. Good afternoon, everyone. Today, my discussion will be on the U.S. state and local government debt markets, also known as the municipal bond market. My presentation will cover the size of the municipal bond market, the types of municipal bonds, and specifically Build America bonds, which began in 2009. Historical default rates on municipal bonds versus corporate bonds, as well as the Meredith Whitney fiasco last year, and the state of the states, the outlook for the states, as well as the spreads on taxable and tax-free municipal bonds. The U.S. state and local government debt market, also, some people actually last year, I believe, or 2 years ago, Moody's tried to give it a new name, sub-sovereign, never really took off, but we included it here for this presentation. It's roughly $3.8 trillion in size. There are over 90,000 individual issuers of state and local government debt. And what you see here is actually there's been a recalculation on the amount of debt that is outstanding. When I spoke here 2 years ago in this beautiful hall, it was estimated to be roughly $2.8 trillion. Citigroup did a study and aggregated all of the municipal bonds out there, and what they found is it was substantially larger than previously thought, by the tune of about $1 trillion. So I stand corrected in terms of, or I have corrected that here for this presentation. And I think it's rather interesting that this is while this is a niche area within the fixed income, the U.S. fixed income markets, it is rather substantial in size. What is a municipal bond? Well, it's a bond issued by a state or local agency or a local government, a city or a town. And there are two basic types: a general obligation bond, which is secured by the full faith, credit, and taxing power of the entity. And then there are revenue bonds. Revenue bonds are secured revenues from tolls, user charges, or rents derived from a facility that's been financed. Historically, the municipal bond market debt is exempt from federal income taxes. And during the financial crisis, the Build America Bond Program was created to increase the amount of taxable municipal supply to attract interest from other investors. This chart takes into consideration the various forms of U.S. government debt. In the top panel, that's federal debt, U.S. Treasury securities, which now approximate 100% of GDP. Since the financial crisis, that has really been on a tear. In the middle panel, you have GSE debt, Fannie and Freddie debt, which is now approximately 40% of GDP. And now you have, on the bottom panel, state and local government debt, which is slightly below 20% and is showing an improving trend in terms of the reduced supply of municipal bond debt. Specifically, Build America bonds were created during the financial crisis, the Stimulus Act in February of 2009. And what that did was it permitted state and local governments to sell taxable bonds instead of tax-exempt bonds. And they received a periodic interest payment, a subsidy from the federal government to the tune of 35% of the interest on the bonds for the life of the bonds. So most of the supply that was created were long-term bonds, and it was attractive at the time. And towards the end of my presentation, I'll show you where, how this has progressed and what the incentives were for municipal issuers to issue Build America bonds. So Congress created this program in order to broaden the market, and you'll see momentarily how narrow the market was versus how it is today. The program expired in December of 2010. At that time, or leading into the last quarter, we saw a tremendous amount of issuance in the Build America bond area as issuers who were planning to issue debt in 2011 and beyond were forced to come to market much sooner, and it really created a big bulge in terms of interest rates that period of time. So this program has now expired, but the taxable municipal bonds are really catching on with investors around the globe. The pie chart that you see to the left is what the municipal bond market was like prior to the Build America Bond Program. Roughly 75% of all investors were retail investors. There really weren't pension funds who would buy them because the yields were typically lower than what they could get on the riskless U.S. Treasuries all across the yield curve. So with this program, we broadened, or the program broadened the amount of investors who could now buy municipal bond debt. Those are taxable bond funds like a PIMCO or a Legg Mason. You have public and private pension funds. And most importantly, it brought in international investors, brought in non-U.S. corporations, banks, sovereign wealth funds, as well as individuals. So the program was very much a success. Build America bonds and taxable municipal bonds in particular have some very positive credit characteristics. The essential ongoing nature of state and local governments is a positive. For many of the revenue bonds, these are monopolistic services, and you also have strong legal protections for bondholders. And even when a municipality gets into trouble, let's take Detroit in the US or Harrisburg, Pennsylvania, they typically receive assistance from the state capital to get their fiscal houses in order. So typically, states step in when a city or a locality runs into trouble. And what we found is, because many people did not understand, in the taxable area, did not understand municipal bond credits, they typically offer higher yields than what you get on corporate debt, similar rated corporate debt. Does sub-sovereign equal subprime? No. We're going to get into historical default rates here for a minute, but you'll see they have exceptionally low default rates. This may be a little hard for people to read, but basically what it shows you is comparing municipal default rates to corporate bond default rates. And if you look at the lowest rated investment grade bond, a BAA bond, over a 10-year period of time, it has a 37 basis point chance of default over a 10-year period of time. Spectacularly low, 37 out of 1,000. If you were to look at the BAA default rates in corporate land, you see that it has an almost 5% default rate, or 1 in 20. So clearly, state and local government debt is a much better buy, and you benefit from having higher yields than on similar rated corporate debt. And at the highest levels, it's virtually non-existent. Defaults really don't occur. Certainly not at the AAA level, but even at the AA level, 1 out of 1,000. So it's pretty low default rates. Comparing GO and non-GO debt, basically revenue debt, it also has extremely low default rates, and there are virtually none in the investment grade area for general obligation debt, the full faith, credit, and taxing power of the entities. Let's delve into market measures of the health of the states. This is the state that has had perhaps the most difficult time economically, Michigan. What you see is obviously credit default premiums spiked during the credit crisis, but they've steadily come down, and now Michigan is actually considered a fairly good state. There are a couple of others who have significantly difficult times right now, but Michigan has managed its fiscal house very well. It's done a good job in spite of what's gone on in Detroit and the loss of tens of thousands of jobs in manufacturing and in the auto industry. The problem child in the US is California. It's, I believe, the 7th largest economy in the world, and they tend to have some problems there fiscally in California. Again, a similar type of chart where premiums on credit default swaps went skyrocketing in 2008, but they've had consistently lower highs and lower lows. So even California is now being viewed as not really a problem from a credit, from a default standpoint. The other problem and lowest rated municipality is Illinois. Similar story here, and you see at the end of 2011, credit default premiums started to decline. Illinois made some changes within the state. They raised taxes, they've cut programs. They're doing the things that every state does in this type of an environment. One of the gilt-edged states, AAA rated Maryland, really hasn't changed very much, extremely low default default premiums there, as well as Texas. Texas, too, has really had no panics from a credit default perspective at all. Meredith Whitney Whiplash. Meredith Whitney is a bank analyst. She's known as a banking analyst and had some good calls during the financial crisis. And last year she decided to get involved in the municipal bond market and made some rather outlandish predictions on a TV show in the States called 60 Minutes, which is watched by tens of millions of people on Sunday night. And her forecast was for hundreds of billions of dollars, or well in excess of $100 billion in defaults the following year, in 2011. And she was so far off the mark. In 2010, defaults were lower than they were in 2009, and 2009 was less than 2008. So you really didn't have anything close to her predictions coming true. But where she did have an impact was on the retail investor, that 75% of this market, where these people had experienced the tech bubble bursting in 2000. You had the financial calamity of 2008, and we saw significant declines in not household wealth, but in the values of people's homes. So when someone comes up and says, this market is headed for trouble, they just sold. And unfortunately, they sold without really examining what they owned, and it created an opportunity for money managers like us who saw it, who've been doing this for 20, 30 years, and saying, this is an opportunity of the decade. So she created a bubble, or I shouldn't say a bubble, she created a lot of trouble in the market, but ultimately it cured. And what was also interesting is, after her comments, you had the taxable bond market and the Build America bond market go in the opposite direction of where the tax-free market was headed. So while spreads and yields were coming down on Build America bonds, they were going up on tax-exempts. So only one group could be right, and it turned out the institutional investors on the taxable side were correct, and ultimately munis wound up coming back down once we saw defaults were not really going to occur. State and local government employment is declining. We see that in the payroll numbers. You see here, starting in basically late 2009, private payrolls start to increase. That's the red line on the bottom. But state and local government employment is still declining to this day. And when we look at other recessions, you see that this recession is the worst out of any over the last 40 years. Where have the cuts come? Significantly, these cuts, unfortunately, have come in education, teachers, teacher aides, et cetera, programs being cut for school children across the country, but that is a fact. This is what is happening in the U.S. economy, but that is where many of these cuts are taking place. Significant declines in the education employment at the state and local level. I included this chart to highlight how much state tax revenues are in sync with, yet lag the business cycle, the economic cycle. And so when you look at this chart, what you see is there are typically tax revenues are lagging the private sector of the economy. And it's most pronounced in this most recent recession, where the economy bottomed about 3.5% in GDP, and yet look at tax revenues at the state and local level. They just plummeted. And because it's a lagging indicator, the states did not feel the recession in 2007, 2008 as private companies did. It wasn't until 2009 where they said, whoa, tax revenues are just not coming in as they had in the past. So this is why you're starting to see these slashes in government programs and government spending. This is a snapshot of the municipal bond market versus the yield curve versus the U.S. Treasury yield curve. The red line is munis. This is a more normal relationship between municipal bonds and treasuries. The shape of the yield curve just happens to be flat here because in 2007, the yield curve was flat. But normally, even in an upward sloping environment, you would still see municipal rates lower than U.S. Treasuries. And I included the taxable equivalent rates here so you can see as we move forward how much stress the markets were under and how much value there is in this sector. But let's look at the height of the financial crisis, December of 2008. Treasuries are now yielding significantly less than municipal bonds. This is a AAA rated yield curve for municipal bonds. And look at the taxable equivalent yield on municipal bonds. It's a ratio of over 300%. You have a 2-year treasury that's yielding about 2.5, and a 30-year AAA rated municipal bond, the taxable equivalent yield is well in excess of 8%. But there was stress all over the market, so let's look at what's happened since. And in April of 2009, we started the Build America Bond program in the US, and so we included the Build America Bond yield curve, which is the green line. And what you notice is out in 30 years, where most of that debt was issued, they were yielding just about the same. And that sort of made sense. But 6 months later, what we see happening is, because of the influx of new monies, sovereign wealth funds, et cetera, pension funds, taxable bond managers, we see those yields start to decline on Build America bonds, and yet long-term tax-free bonds, the taxable equivalent yield, isn't very much different. So clearly, the Build America Bond Program was successful in reducing the interest cost to the issuers and alleviating the problems that they were facing in the tax-exempt market. A year after the program, again, you see Build America bonds coming in terms of yield. The taxable equivalent of tax-exempt bonds not significantly changed, but we are back to a more normal relationship between munis and treasuries. So muni yields were slightly below. This is 2 years ago. November 2nd of 2011, this is just on the day of the, I should say, this occurred, what happened here is we saw that taxable bond yields started to come down with the significant decline in U.S. Treasury yields. You have the U.S. Treasuries yielding a little bit better than 2%, and yet the municipal bond market is basically lagging once again. And this is where we are today. Again, you see the U.S. yield curve significantly below the tax-exempt area, and yet Build America bonds are now yielding less than 5% out in the 30-year area. So clearly that's been a success for investors, it's been a success for the issuers, and yet you still look at the taxable equivalent yields on tax-free debt, and they're not significantly different from where they were in 2010. Thank you.
Thank you. Michael Drury.
Before I start, I'd like to thank David Kotok and Christian Noyer for this wonderful conference. David for letting me sit up here, and Christian for making the room available, because this is the best room I've ever given a presentation in. And it's way better than the Holiday Inn at Memphis, where I gave my last gig. So, I'm going to give some thoughts about commodities, and as is always the case when I do these, I'm going to start and finish with China, because China drives almost everything as far as commodities demand is concerned. We use what's called the Li Keqiang rule in terms of understanding where China is. Li Keqiang is the incoming premier of the country. When he was the governor of Liaoning province, somebody asked him which statistics he trusted most in China, and he said there are only three: rail traffic, electricity, and bank loans, because all other statistics in China are made up. Now, when you look at those three today, if you look at rail traffic and electricity production on this chart, you'll see that where we are now is very similar to where we were back in 2000 through 2002, and at that time Chinese GDP was growing about an 8% annualized rate, and that's about where we think the Chinese economy is. Now, some people like Rio Tinto and folks who are closer to the iron ore and the cement and the residential construction areas will tell you that it's growing as slow as 5. It's clear it's no longer growing 9 or 10, but we don't think it's as low as that. I did not use bank loans on this chart because one of the reasons that the current slump in China is going on, some of the statistics early this year have been softer than expected, is because the Chinese are trying very hard to get their bank lending under control. Typically in China, bank lending, 40% of all loans in the year go out in the first quarter. 30 in the second, 20 in the third, only 10 in the fourth quarter. Basically, the SOEs line up at the beginning of the year, hoard as much as they can get, put it into all kinds of silly things at the beginning of the year when they don't need the money, and then finally take it back towards the end. So this year there was a decree that they wanted the lending to go out 30 in the first, 30 in the second, 20 in the third, and 20 in the fourth, which means that you've got roughly 10% less credit going out in the first quarter, and therefore you've got a credit crunch going on. It will be somewhat relieved in the second quarter when credit goes back to normal, and in the third, but you really won't see the benefits until the fourth quarter when credit that's normally not available finally works its way into the system. We're long-term bulls on China, and it has very much to do with where China is right now in per capita growth income. When you cross the $3,000 per capita income point, very good things begin to happen in your economy. That's what happened back in the 1950s for Japan, 1970s for South Korea and Taiwan. Basically what happens is when you get to $3,000 per capita, the high-income people in your country are like $12,000, and they're starting to buy durable goods. Durable goods require bigger factories, they require inventories, they require infrastructure, railways, roadways, electrical grids, and so there's a tremendous boom in investment that happens at that point. And it carries on for a very long time. In the cases of Korea and Taiwan, from the point they reached $3,000 per capita GDP till when they started to slow down was roughly 20 years. And they were at about an $11,000 per capita level when they started to slow down. In China today, a lot of people think that income is much higher than it is because they go to Beijing and Shanghai and Guangzhou province and they see all of the wonderful skyscrapers. And I strongly advise you to go 20 miles outside of any one of those cities and see the other China, which is much, much different. Over 500 million people in China still live on farms, and their incomes are very, very low. In fact, the Chinese just raised their definition of poverty to $1 per day, and at that level, they added 110 million people to their poverty rolls. Now, their poverty rolls had only been 16 million, so it was a significant increase. The reason they didn't go to the international standard of $1.25 a year is because that would add another 100 million people to their poverty rolls. So you have roughly 225 million people living below $1.25 a day, or under $500. By their own admission in their new tax codes, they raised the threshold level for paying taxes in urban areas from $2,800 a year to about $6,000 a year. And at $6,000 a year, only 7% of the population in China pays taxes. Now, they don't actually pay the taxes. They're just required to pay the taxes. No one in China pays taxes. As you can see, this chart is just to show that this is what happened in motor vehicle production in 2008, which was the year that China hit $3,000 per capita, and motor vehicle sales exploded. China is now the largest motor vehicle producing country in the world at about 19 million vehicles this year, and it's expected to go to 20 million next year. The problem is that all of the vehicles that have ever been produced in China, except the ones that they wreck, and they're very, very bad drivers, are still on the road. And there are less than 100 million vehicles in the entire country. So they still have a very, very long way to go in this durables acquisition process. This is a chart that just shows you where they are relative to where South Korea was at the same time. And if you look at like 1997, that's when South Korea started to slow down. That'd be 20 years from now, and if China only grew at 5% a year for the next 20 years, it would be 3 times as large as the United States when it got there. The question for commodities markets is, can China do that? Now, China admits that it's going to slow down to only 8.5% growth over the next 5 years instead of the 9% growth that they used to admit to. They beat their growth rate every year, so we don't expect them to slow to 8.5%. We're not really sure what the number is, but if they were to grow 9%, I mean, just do the math. If you're at 100 and you grow 10, now you're at 110. If the next year you slow down to 9, that's 10, so you're at 120. The next year you slow down to 8, and so on and so on and so on. So if China doesn't go from 10% growth to 5% growth over the next 5 years, and we find that very, very doubtful, then they will continue to be an increased demand factor in all commodity markets around the world. And given their size, that's a very, very significant number because they account for more than 25% of commodities demand in almost every commodity now. We look at soybeans as an indicator of what's going on in China because they import almost 100% of their soybeans. And most of those from the United States, and so we get pretty good counts through the American exporting companies, and so we know where they are. You can see from this chart that their demand started to explode back in 1992, and it looks very similar to what happened in Japan and what happened in South Korea. They're already up to where the Japanese are now, and the Japanese slowed down very quickly. And they're halfway to where Korea is. So the question is, well, are they halfway to where they're going, or are they done, or are they going to go beyond? And the first observation is that the Japanese import about half of their meat, which means that they don't need to import the soybeans to feed those animals. They import them in the form of the meat already. The Koreans import about 25%. The Chinese don't import any of their meat at all. So there's reason to believe that the high levels, or the levels of the numbers for Japan and Korea, can be exceeded if you're not importing meat, you're just importing meal to feed your own animals. The second factor is that Japan, 61% of food consumption, meat consumption in Japan, is seafood. It's an island. It's surrounded by water. The cheapest form of nourishment, the historical form of nourishment, is fish. South Korea is a peninsula, and it gets 55% of its food intake, or its meat intake, from fish. Well, most of the Chinese are on the coast, and so they're at 36%, but they are a continental population, and as incomes move inland, there'll be less and less seafood and aquaculture, and the trick there is that it takes 1 pound of grain to feed 1 pound of fish. It takes 2 pounds for chicken, 4 for pork, which is the preferred meat in China, and 8 for cattle. We think that there's going to continue to be a very substantial demand for grains as a result of them continuing to move up the food chain, and as a result of their government continuing to push to raise incomes of the lowest income people, particularly this year, which is an election year, or as close as you get to elections, in China. Now, one commodity that we're not very bullish on, and this is a huge swing from last year, is corn. And it's basically the invisible hand doing its magical work. A year ago, we were at a point where corn production was because of droughts in particular, was very low, and there was a risk that the carryout, that the inventories at the end of the crop year would not be large enough to get out of the crop year without literally running out of corn. And as a result, prices went very, very high. As a result of those prices going very, very high, farmers all around the world, but particularly in the United States, and particularly in the northern United States in places like the Dakotas, have planted fence row to fence row every acre of corn that they can get in the ground. And we are at a record high number of acres being planted to corn. At the same time, one of the major reasons for corn prices being high last year and for corn demand being so strong has been ethanol. In the United States, 40% of all corn produced goes to ethanol production. And that's a mandate by the federal government about how much grain has to be produced for the alternative energy programs. Now, they were producing so much that they were actually overproducing the mandates in the last several years. And as a result, they have gotten rid of the subsidy for ethanol production in the United States. We used to pay 45 cents a gallon, whether you exported it to Brazil or whether you kept it in the United States, and they've gotten rid of that. They've also gotten rid of the tariffs against Brazilian sugar-based ethanol coming into the United States, but it's still profitable at current prices, particularly because energy prices are high. But we don't expect that there'll be a continued ongoing strong demand in growth terms from ethanol, but just at a level. So we have more acres, we have no more going to ethanol, and this is what we call the agricultural chart of the century. The century is very short, so we can get away with something. But the bottom line is this is an internal model that McVane uses to look at how much grain will be fed to cattle in the United States. Of the grain that does not go to the ethanol industry, 50% is consumed by cattle. The cattle consume much more than pork or chickens just because of the size of the animals and the conversion ratios. And as the result of very high corn prices in the last several years, farmers or ranchers have been liquidating their herds. And this year it's become particularly aggressive in the speed with which they're liquidating their herds because of what happened to grain prices last year, and strangely enough, because cattle prices are so high that they can get out of the industry at a good get-out point. And the average rancher in the United States is over 65 years of age. He doesn't really want to be in the business anymore. He wants to retire, and this has turned out to be a good time. So as a result, in corn, we're in a situation where we see a fairly substantial increase in supply and declining demands. So last year, where we were north of 750, we think it's possible later this year that you could revisit the prices that you had back at the beginning of that chart in the high $3 range, that you could have a 3 handle on corn. There's nobody else going to tell you that, and I didn't say it either. Now, this is a chart of copper. Now, when I asked my assistant, V. Sinitsin, to put together this package, he gave me this package, and I yelled at him, and I said, V, what are you doing? You've screwed up, and you put the corn chart in twice. Go back. They're the same chart. And that's the point for a lot of commodities. They're the same chart. And what they basically are is a euro chart. And the reason they're a euro chart is because the marginal investor in commodities, the marginal investor in everything in the world, is a German with money to spend. And he spends in his home currency. And so we spend a lot of time looking at things in euros and making adjustments because the currencies have so dominated the financial markets, all of our markets, that it's made a lot of these charts have extremely high correlations. Going forward, we don't think that copper and corn will have a high correlation. One, because we think corn's going to fall, and we don't think copper is. Unlike corn, copper cannot rapidly increase its supply. They're not planting acres and acres of copper, and they're not bringing any new mines on either. In fact, Rio Tinto and those guys are cutting back because they're afraid that Chinese demand is cutting back. And we think that the Chinese slowdown is only temporary, so we're still fairly bullish on copper. And then the final commodity I'd like to talk about is crude. I always like to do 3 C's, corn, copper, and crude. Crude oil prices right now have a very, very large component of Iran in them. My wife is Iranian. I follow Middle Eastern politics very closely. I can tell you nothing about what's going to happen in Iran. And anybody who tells you that they can tell you what's happening in Iran is lying to you, because they don't know either. But there's a very strong price component of what would happen if the Straits of Hormuz were shut down in current crude oil prices. I will tell you that oil prices are very, very seasonal. And at the current price in the United States, we're at about $3.88 on gasoline. If you hold this seasonally adjusted price through Memorial Day, you're looking at $4.35 gas. That's the highest it's ever been. Crude oil would be at about $125 a barrel at that point. And those prices would not be lower until after Labor Day, early September in the United States. So we think, whether there's an issue with Iran or not, that oil prices are going to be a basically interest rate hike on the U.S. economy over the summer, and they're going to be a drag. If I had to bet, I would say that there's too much Iran in oil prices currently. I'm one of the few Americans who has been to Iran and to their nuclear sites. My father-in-law was a contractor who helped build them, and he told me in 1995 that no one would ever bomb them because they're too far underground and they're too hardened and they're too spread out, and besides, they didn't need to. And I said, what do you mean you don't need to? He said, well, every third person in the Iranian nuclear program is a spy. Israeli spies, Pakistani spies, Saudi spies, Russian spies, Chinese spies. Everybody has an interest in making sure that they have a nuclear program because they pay a premium for everything. And everyone has an interest in making sure that they never finish. So, I mean, if you read the Iranian papers, which is tough to do because they're in Farsi, but if you follow it, you'll notice that there's a lot of kidnappings and defections and sticky bombs. It's a very, very dangerous thing to be a nuclear scientist in Iran. And I suspect that it's the subversion, the assassination, rather than the overt attack methodology that will be used. And as Wall Street becomes bored with the fact that the Israelis have not attacked this week, I think that you'll see oil prices moderate over the summer.
Michael spent a lot of time talking about China, and obviously you need to follow that on the commodity markets. The best way to put it in perspective, Jim O'Neill from Goldman Sachs came out with a report a couple of weeks ago quantifying that Chinese growth every 6.5 weeks is the equivalent of Greece's annual GDP, just to kind of put the growth rate in perspective. Stephen Sexauer?
Well, after a day that started out wonderfully with Paul's rather call to arms by policymakers, and then identifying all this somehow with Occupy Wall Street, and then Bill's great history, and then central banks, and then GSEs, munis, commodities, we find equities both at the end and standing between you and the wonderful Paris sunshine. So I'm going to try and cover 3 points, and then we'll go to Q&A. So point one, at this point in time, all that matters for equities is growth. Point two, if we grow, we'll de-lever. If we de-lever and we grow from here, March, late March, I think you'll see emerging markets up another 5, 15%. I think you see the U.S. up from here 5, 10%. And interestingly, though it's a cliff on the other side, I think you could see European equities up another 15 to 25% from here. So you may prefer to be in the Paris sunshine after hearing all that. But let me go through why I think that. And I want to add one other thing, is that most of the conversation today has been on monetary policy, which we had in the panel before us, fiscal policy, or the interaction between the two. And I'm going to add a third dimension here, and I would encourage you to think about it, and that's real side policies that affect output in the real economy, because as an equity investor, just like we're at the end of the day today, showing David's brilliant scheduling, we're also the residual claim on everything else that happened. So when we go through this, just remind us all the obvious, right? If there's no GDP growth, we're going to get no profits growth. If there's no profits growth, PEs are either going to shrink or be stagnant. Equities will be very volatile. Returns will be stagnant. So we come to, at least where I live, 3 invariant rules of equities. One is, if you want real growth, it only comes from 2 places: more people working more productively. It's an accounting identity. So you need policies that get people working and productively. Since we're trying to pay down debt that's nominal, you would then care about nominal GDP. Second invariant rule is, and there's some tables at the end where I'll go through where I got the returns for you. In equities, you only get 3 things, ever. No matter if it's Bill investing for you, or me or anybody else. You get the change in the earnings, that's the growth. You get the change in the valuation on the earnings, and you get dividends, and that's about it. There's nothing else. And then the third rule is never ever fight the Fed, the ECB, or liquidity flood, ever. So let's look at kind of where we were, where we are, and then think about the future. I've got a map up. I'll walk you through it briefly, and then we'll kind of go through both the fiscal factors, the policy factors, and the real side factors. So as we know, when Lehman failed, and then the next day the reserve fund failed, so everybody in America went and took their money out of their money market funds. We had a non-bank bank run, or to use Paul's brilliant alliteration. We had shadow banking. It was 11% of GDP. So just remember, next time the news is talking about a revision of 10 basis points, the bank run in the US was 11% of GDP annualized in Q4. The world stopped. It broke. Okay, we're still living through the breakage of a very deep recession. Where are we today? Well, we have QEs in the US, we have LTROs in the Eurozone. In my assessment, in the US, the Fed and the FDIC saved the day and saved the world. And you're seeing that now unfold in the Eurozone with LTRO. The European Central Bank has said we're not going to let the system stop again because of illiquidity. So that leaves us as what are the policies for growth and where are we? So let's go around the world. The emerging markets are growing. China, we know, is growing slower, but it is still growing. The US is growing, below trend, but it's growing, and the European markets are a bit split. In the north they're growing, in the south they're not. But the policy focus is to have them grow. So if you look at the arrows on the chart, we're somewhere between growth and deleveraging, where I had the markets up, and slow growth. So if we have slow growth, flat markets from here is probably pretty good, because they've been up a lot, and valuations are somewhere between low and fair, but they're certainly not screamingly cheap. I'm not even going to go down the path where we don't grow, because we won't be here next year or the following year. So here's the possible outcomes and the returns. Let's just go through the big picture issues. Never fight the Fed, the ECB, or liquidity flood. Okay? In emerging markets, we're already seeing easing cycles. We're in spring floods. The US is a tsunami. And we have spring floods turning into a tsunami in the European markets. How about fiscal policy? Well, it's actually okay in emerging markets. The US, completely wide open on the federal side. Clearly, there's austerity on the state and local side. In the European markets right now, where I sit, it appears to be circular firing squads of austerity. It's not a good thing. That's a negative. Debt to GDP, kind of where the bomb went off, the binding constraint. It's under control in emerging markets. Unclear in the US, but that's because we don't know what our growth path is going to be, but clearly fixable if we grow. And it's also unclear in the European Union, again, a function of growth, and the ECB has given us a window to grow, and I would encourage everybody to read all the news on Italy, because if you look what's happening in Italy is they're working on the real side reforms, they're close to a primary surplus, if not in it, and they have the tailwind of the LTRO, and I'm going to show you an example of some numbers, but if Italy's earnings get back to where we thought they might be this year, 2 years ago, a not unreasonable multiple like 12, even from here, Italy could be up 50%. So that's the kind of, in a positive way, use a Bill Gross term, nitroglycerin there is to growth and fixing things. So if you look, let's look at the last data point, incentives to hire and to have productivity. Clearly, in emerging markets, the answer is yes. In the US, it's kind of limited to no right now, right? We've had nothing but regulatory pressure. President Placer talked about Dodd-Frank, and I think Josh did this count. I think there's like 16,000 pages of rules that have to get written. So the amount of regulatory overhang and potential overhang from Obamacare is actually quite large, but fixable. And, again, for where I sit right now in the European Union, just austerity rules the day. So it seems to be going the opposite way that you would want. Finally, equity valuations. Emerging markets are at the lower end. The US are probably fair, and Europe, they're low to fair. So I'm going to end with a simple framework and a table. The column under EPS is literally consensus earnings for this year and next year. That's the 111 and the 98. 90 was last year. 74 was kind of the low in the last round. And you don't need a calculator. You don't need an HP 12C. You don't need a computer. You certainly don't need an optimizer. You know, we kind of started the year around 10 times. We're now up closer to 11, 12 times. Earnings are going to probably grow 10% in emerging markets. If the multiple and low interest rates just gets to 12 or 13, and by the way, it's been there a lot, those are the kind of returns you'll get. I'll do the United States, a little bit more muted. We think we're going to go from 99 to 104. By the way, these are just consensus earnings, they're not mine. So it's 5% earnings growth. You know, the multiple, 12, could it go to 13 or 14? Absolutely. Could we grow more than 5? Absolutely. You can look at the numbers in the triangles. Here's the Eurozone. I gave you Italy's specific numbers a minute ago, but there's potential leverage to see equities come back if we grow. And I'm going to conclude my comments with one thing to follow up that I think is just crucial to what Bill and others said is there's been some good work done that shows when equities go up, people spend. And if you're going to rebuild growth, that's a good way to do it, is to get equity earnings up, get multiples up. The wealth effect is enormous. And I'll give you a factoid on that. One of the major card processing companies, when they look at the data, they've been looking at where the credit expansion is coming from in the U.S. Federal Reserve numbers. So you'll come in the morning and you'll say, you know, credit grew 3 or 4%, grew 5%, credit balances. All of that growth right now is from households above $200,000. So just let me repeat that. All the credit statistic growth you see in the economy is from households above $200,000. So what does that tell you? It tells you if we grow, if equities go up, people will spend, and you're in a virtuous circle built around growth. So I will finish there.
So I'll use moderator's privilege to ask a question or two, and then we'll turn it over to the audience. You know, Bill Miller, we talked about, used the term risk on, risk off, and referred to it as uncertainty on, uncertainty off. And it's my sense that most investors are spending a lot more time these days focusing on monetary, political, geopolitical events than they are in the fundamentals of their own markets or asset classes. And it's almost to the point where if you tell me how treasuries did that day, I can pretty much tell you how every other asset class performed. Do you think that's a fair representation of what's been happening in the markets that you follow? And more importantly, how have you adjusted your investment approach to take into account this new reality? Or whoever wants it.
Well, in commodities, it's definitely true. I mean, risk on, risk off is pretty much boils down to a currency play. When risk is on, you buy euros. When risk is off, you buy the dollar, and that feeds directly into the price of anything dollar-based, and that's why the correlations are so much higher now than they've ever been between almost any commodity.
Obviously, in the agency debt markets, actually in the MBS markets broadly, the answer would be yes. More broadly in financial industry, the answer would be yes. In terms of the divergence, though, with the underlying collateral values, the answer would be no.
In the municipal bond market, in the municipal bond market, what you see is, since it's still really driven by retail investors, you still see a rather steep yield curve. You see ratios, negative ratios in the front end of the market. In the shorter maturities, retail investors are tending to stay short. They're extremely concerned with potential inflation and risk in general. The longer end of the market, which is dominated more by institutions, we definitely see more of the risk-on, risk-off types of trades. And with Operation Twist on the part of the Fed being implemented, that has served to bring yield spreads down. But again, they tend to lag when there is a major move in the U.S. Treasury market.
So I would add that I'm now adopting the new term uncertainty on and uncertainty off. And I would say it's there, and it's getting bigger each time. But the question is, should you take advantage of it or be concerned. So there's a way to keep track of how much of the volatility in the market comes from macro factors and idiosyncratic news from thousands of individual companies. The spike on risk or uncertainty off and on has gotten bigger each round. So in Lehman, it maybe spiked to 68% of all the movement in stocks was just a couple pieces of news, Lehman. When Greece raised their hand in 2010 in May and said, well, we lied and cheated and we're broke, that uncertainty on trade dominated even faster and higher. And then when the US got downgraded and we proved we couldn't act like adults, and there was concern of another recession, it spiked even higher to almost 80%. My personal forecast is it's going to happen again. It's going to happen, and it'll keep happening because the stakes are so big. I mean, this is a really hard problem to solve. So every time people look at the data or look at the facts and say, this is it, we can't get out of this, they rationally say, oh, and the uncertainty trade-off. The interesting thing as an investor is trying to tease out when that happens, is it real this time? Are we going to die? Or is it an opportunity to rebalance your portfolios back to some prudent place to be?
Just one more and then we'll turn it over. We had a lot of discussion this morning and this afternoon about changes in regulation, particularly on the financial side, Dodd-Frank, the Volcker Rule, Basel III. And just FYI, Morgan Stanley is out with a report this morning saying that the global investment banks probably have another $1 trillion of assets to sell over the next 2 years. My question is, have you already seen changes in the regulatory environment affecting the markets you follow? And more importantly, what do you worry about in terms of regulatory changes going forward that might negatively impact the asset classes you follow?
Well, obviously, as financial service analysts and bank analysts, the answer is an obvious yes. We have seen regulation change it. I think to some degree, though, again, it's more about the uncertainty than it's about the particulars and their onerous impact on the industry at this point. And I'm not sure, by the way, that whether they're onerous or not, that they're all misguided. Frankly, changes in prudential standards are probably warranted and I think worthwhile at this point. That said, what am I worried about? I'm worried about actually the changes in regulations impact more on the macro environment. So as example, when the European Banking Authority said that by this summer the European banks had to get to 9% core capital levels, they gave the banks 9 months to do that, essentially creating incentives for the banks to do it through deleveraging rather than through dilution and equity raising. And so in that case, what you had was the impact of oversight regulation, not necessarily driving the proper outcome for bank capital for their balance sheets, but rather, in fact, the banks extracting a toll on economic growth throughout the system as a way to meet those regulatory demands.
In the municipal bond market, the Volcker Rule may have an impact in terms of liquidity. There's some uncertainty and some worry that it's going to reduce the amount of liquidity to the market if dealers cannot take on proprietary trading in this sector of the market. You may see some dealers decide that the risk of getting into trouble or going out of compliance with the Volcker Rule may create problems for them, and they may decide to actually step away from market making and taking on risk. And I can tell you as a bond manager, what the market really lacks these days is liquidity when you need to get in or out of a trade. So that is a problem for us going forward.
In the commodities markets, the ethanol subsidy was the main, kind of domestic constraint. We obviously spend much more time worrying about regulatory changes and changes in China. And there, to me, the most interesting and I think potentially game-changing rumor, because everything's a rumor in China, recently is that they may be forming hedge funds that are registered in Shanghai for the sole purpose of investing outside of China. If China were to open its capital markets to the world, it would have profound effects on the prices of everything.
I think we always have regulatory issues, and I think in today's context, they're kind of rounding errors. I think the big things are the things that were mentioned this morning. If we have fiscal austerity strangling the recovery, if in the U.S. we run off a fiscal cliff, if there's some revolutionary movement in the polls to take away the freedom that the central banks have had to operate along with treasuries as adults, I think those are the big issues.
One quick response, though, on the Volcker rule, because to some degree, I worry that it's being overly focused on. It's become the new rallying and lobbying issue for the industry, obviously. And the way the rule was being considered and drafted by the U.S. regulators was intended to take into account the difference between market making and proprietary trading. And I think that the regulators have been, very considered toward that end. So I worry that in terms of the Volcker rule, look, it's essentially, to some large degree, a lobbying effort to make sure that the systemic safety net remains extended to those institutions through the central bank.
Time for one or two questions from the audience. In the back over there.
Hello. I just wanted to make the observation that BIS Quarterly Review, which was published about 2 weeks ago now, has a great little section on about the European bank deleveraging. You'll recall that there were estimates going around late last year of 3 trillion euros of assets being disposed. But what this little article does is to point out that the European Banking Authority has actually gone through plan by plan with each bank that is shortfall to 9% as to how it's going to get to 9% core tier 1 capital ratio by the middle of this year. And the interesting thing is that nearly all of the efforts are going to be on the capital raising front. And the BIS concludes that rather than 3 trillion euros of bank deleveraging on account of this, it is likely to be around 220 billion euros, which isn't so much in the context of a 9.5 trillion euro economy, particularly when that is really coming about through the external asset side in particular. Thanks. Sorry, it's not really a question, but I think it's an important point I'd just like people to be aware of. But please comment, Neil.
Okay. We have time for one or two more. Over here on the left. Paul?
Since the low point on March 2009, when my favorite bank hit 97 cents, the equity markets around the world are up about 85, 90%. And I'm wondering at what point will the 10-year Treasury yield begin to represent a threat to those equity gains? 250, 275, 3?
Anyone want to take that one?
I would think it's north of 275. I think it would be north of 275, 2.75%, where you would have 10-year treasuries impact the stock market, probably closer to 3.
I think it's how you get there. If the economy's growing and renormalizing, then I think people would smile at 350 on the 10-year and think this is a good thing. If it's because of stagflation, then you'd think 350, 450, 550, and it's a really bad thing.
I mean, from my perspective, if we go from 2.25 to 3, some part of you would say, look at the 3% yield and compare it to equity values. The other part of you says, if it went from 2.5 to 3, is the next stop 4? Right? And then what kind of capital losses do I have on that investment? So it really, as Steve said, it really does depend on the environment and the pace at which it gets there, I think.
The E's in the PEs, at least in the United States and some other countries, are at all-time highs. And so If the E normalizes, equity returns really could be quite a bit lower than you're looking for. How confident are you that the high earnings, high profit margins are sustainable?
You would ask that question because the margins, you know, this is the inside baseball version of Occupy Wall Street, right? That the returns to shareholders through profit margins are clearly at all-time highs. And if you take a look over time of corporate revenues that go to pay compensation, go to pay taxes, and go to pay the shareholders, and for years now we've been looking at that number saying that there has to be mean reversion, it has to come back. I personally have taken the position, and I'll tell you why in a second, that until it starts to come back and I see evidence of a structural change, maybe it's 0.3A, don't fight that. And there it has been some good work that says the structural change, the true structural change in terms of companies and profits and regulation, that could continue. So, but it's a big risk. I mean, if you start to see that trend back to where it could be, then the E is going to fall secularly for 3, 4, 5, 6 years or longer.
I think we're set.
This panel for their excellent wind-up for us. We've worked very hard today and have summarized this program continuously as we've advanced it. So I will now not deliver the 2.5-hour speech about what we did today. It's been a pleasure. I hope you enjoyed it. Many thanks to our GIC members, our speakers, people who support us, and especially to Christian Noyer and the Banque de France for hosting us. I hope you enjoyed the environment. We'll consider this day adjourned. Thank you.